Hi, Pragati here. This is the first part of the three-part series video about how to assess profitability of a buy-to-let investment. In this video, I'm sharing how to use rental yield to assess profitability of a buy-to-let investment property. Like in any other investments, you will need to assess the likely profitability of the investment before you invest or before you put the money into it. To do this, most buy-to-let investors use rental yield. You will often hear investment companies and mainstream media referring to high-yielding towns and cities and property hotspot areas with figures in excess of 10%. But that is often just to catch the attention of the investors. It doesn't take into account, or it doesn't explain clearly whether it's a net or a gross, so which could be really misleading. And it's really important to understand how to calculate these yields and how to take that to your advantage. Let's look at the formula to calculate the rental yield. So that is annual rental income divided by the purchase price times 100 to get the percentage. So let's for an example, let's say £600 per month you get in, times 12 will give you £7,200 annual income, divided by 110,000 gives you a 6.5% yield. Bear in mind, this is a gross yield. Okay, it doesn't take into account all the running cost of the properties, so you should not take this gross yield as a deciding indicator, because it doesn't take into account all the other running costs of the property. However, net yield will give you a bit more insight on the figures. So the net yield is pretty much, the formula is same as the gross yield. However, you replace the annual rental income with the net rental income. The net rental income is your total income minus all the running costs, all the expenses that you will incur in running the property. So what are those running costs? So that's what we're going to look into. But according to a leading research, a surprising 75% of the buy-to-let investor landlords do not take into account all the top 10 most common associated costs in running the property. More surprising is actually 1 in 8, which is 12% of the investors, do not take into any cost at all in account, which puts them into a very, very difficult and a dangerous situation where their assessment of the return is going to be completely different. Okay, so now let's look at the running cost of the buy-to-let property. There could be repairs and maintenance, letting agents fee up to 10% of your income, mortgage payments, insurance, that could be building insurance or your content insurance, void periods, safety checks such as gas safety checks, electrical safety checks, licensing, service charges and ground rent if the property is a flat, and utility bills and council charges where the landlord is paying these bills instead of the tenant. All these things put into account could take up to 40 to 50% of your annual rental income. So if you take this figure back to the previous example, we take, let's say, from your annual income you take 40% off for the expenses, and that gives you a 4,320,000 annual net income, divided by the purchase price, which is 110,000, gives you a net yield of only 3.9% compared to the 6.5% gross yield which we explained earlier. Now, like I said, all these the medias and companies, they sometimes they might just try and catch your attention by giving you a gross figure which is always higher. As you can see, there's a big make or break difference between 6.5 and a 3.9 yield. So you have to be really careful what you read and what you see, and do your own due diligence and do your calculations to make sure that you understand those figures. The bottom line is, you should know your numbers very well, what they mean and what you should use it for. In the next video, I'll be explaining you about how to use the return on investment on the buy-to-let investments. Thank you for watching until the end. I really appreciate that. And if you found this video helpful, please like and subscribe, because it will help bring the video up on the channels, up on the websites, and it will help other people as well, like yourselves. Thank you once again. Happy investing for financial freedom.